I don't own gold because I think it might go from $2,400 to $2,700. I own gold because I'm afraid it'll go to $9,000 or $10,000. Somebody who has less fear than me probably wants to own a little less.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for June 24th through July 1st, 2024, while supplies last. First, we feature Ital Preziosi silver kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty in Finance. We're always glad to have this widely followed returning guest, Rick Rule, a legendary investor and especially knowledgeable in the natural resources space, former CEO of Sprott Asset Management, now the CEO of Rule Investment Media, and the founder of the Rule Symposium on Natural Resources Investing, which will be happening next week in Boca Raton, Florida. Joins us again this Thursday, June 27th. 2024. Rick, thanks for coming back on Liberty and Finance.
It's always a pleasure being with you, Dunnigan. Thank you. And I look forward to hosting you and your family in Boca Raton.
It's a treat for us to be able to mingle among the legends and those who are really getting the work done. It's quite remarkable how many companies there are in the natural resources space. And truly, it's like finding needles in a haystack. And you've done so much of the heavy lifting by curating the set of companies that you invite to be your exhibitors at the conference. That we're going to talk about that a little bit later. But just a sneak spoiler alert, there's a link in the description of this video for anybody who wants to make sure you don't miss out. And there's both in-person and virtual attendance. So no excuses for not getting all learned up about who the best companies are to invest in. We'll talk about that later. But Rick, first, we got a whole bunch of questions that have been submitted by viewers ahead of your arrival, and thank you for working us into your busy schedule just the week and a half before the conference here. We have a question that I'm sure you hear a lot, and it's on the minds of a lot of our viewers and subscribers. It's very general in nature, but I think you'll probably be able to give some reflective thought to it. William F8893 asks, my question for Rick is, where the heck is the price of silver going?
As long as the gentleman gives me the leisure of time, I would suggest higher. I've had hours of discussions with you, Dunnigan, about the reason why I think the gold price inevitably goes higher. And my experience has been that when gold establishes the momentum in precious metals, and then the generalist investor comes in, that the generalist investor is encouraged by the momentum in gold. And buys the asset with lower unit costs and more volatility, which is to say silver. This usually occurs about midway through a bull market. No reason why history has to repeat itself there. But when silver assumes leadership from gold, it moves further and it moves faster. I know that the gentleman would like me to give him a date. I'm too old and smart for that. I would just suggest to him that we're in the early innings of a precious metals bull market, and he needs to be patient for gold to establish a dominant trend before silver really gives fireworks to the upside. It's worth waiting for, by the way, Dunnigan. Your younger audience won't be familiar with the dynamics of a silver bull market. The first one, of course, that I lived through was the 1970s, where silver went from about $1 to $50. That's not representative, I think. A better market to pay attention to was the early 2000s market, from about $5 to about $50, a tenfold move in silver. Too many silver bugs these days have low expectations. High expectations in terms of time, but low expectation in terms of dimension. I read all kinds of stuff on the internet about the fact that silver might go to $35. But I could care less about a $5 move in silver. I've experienced a couple tenfold moves and one 50-fold move. So a $5 move is of no particular interest to me.
We've got a lot of questions here about when gold and silver really make a big move, how likely it is that mines will be nationalized in different jurisdictions. There's a question from Forbidden Planet 7777. When silver and gold prices soar to never before seen heights, how many nations are likely to nationalize their country's mines?
I think a lot. Sadly, the nationalization is almost always a sign of a market top. I looked at, as an example, Zambia nationalizing the copper mine. The copper mines, boy, did they top tick the copper price. What happens with bull markets is when they begin to move, they move so fast that they outpace even the greed and incompetence of elected politicians and bureaucrats. So from the time that they decide that stealing private wealth is a good thing until the time when they accomplish it, characteristically 3 to 5 years passes. So while I understand that having a good asset stolen is a bad thing, having a good asset stolen at or near the top of the market is not as bad as it might sound. But in answer to the question, if the gold price, as an example, were to move from its current $2,300 to some number like $10,000, which I don't think is outlandish, the probability that the African National Congress in South Africa would steal the gold mines and then proceed to plunder them, like they did the coal mines or Eskom, I think the probability of that is 100%.
There's a related question here about movements by governments in the face of strength in the metals. At 11 Above asks, if the BRICS nations or any country designates a metal-backed currency, say with gold, why would that make the price of gold rise if China has all they need and the U.S. supposedly has Fort Knox full?
Well, first of all, the probability of a gold-backed currency is nil. A gold-backed currency imposes discipline on politicians with regards to their fiscal measures, and politicians live for power, not constraints. So I think the probability that you see a gold-backed currency anywhere in the world, with the possible exception of Liechtenstein, is nil. If you look at the amount of gold in Fort Knox and you look at the amount of circulation of money in circulation in the United States, you would need a gold price that was almost unfathomable to current holders to back the currency. But as I say, this is a fantasy. People who subject themselves to the indignity of being politicians are people with an unquenchable thirst for power. And a gold-backed currency would impose a discipline on them, which is unthinkable to them.
There's another question here about a potential deal being struck between miners and governments. Bob KL3ES says, do you think the powers that be will make a deal with the miners? You give us cheap copper and charge what you want for the silver.
No. Silver is always a byproduct of copper production. And so the amount of revenue available from a silver stream relative to copper production means that it's not in the company's interest to do that. In fact, what tends to happen is sort of the other way around, albeit not involving governments. What often happens is a copper producer with byproduct silver pre-sells the silver production to a streamer in return for a disproportionate share of the capital cost of putting the mine in production. The governments are much more inclined to steal than to trade. So what I think you'll see in the case of the copper business is de facto nationalization. Rather than stealing the mine outright, you will see them increase the requirement for offsite capital contributions, like building schools, roads, and water systems, increasing taxation, increasing duties, and increasing royalties. Stealing the output very much like the U.S. government stole the oil and gas industry's output with excess profits taxes.
There's a question here about the price of silver and reversion to mean, and you've talked about reversion to mean in several other aspects, and perhaps we can kind of wrap that all together. Poisoned One asks, will silver fall significantly after the 5 to 7 year peaks to the realigned natural ratio is being achieved?
I don't think that the ratio, which is to say 16 to 1, matters because it doesn't take into account utility. Prices move really as a function of utility. Silver has two utilities. One, which is highly speculative as a medium of exchange and a store of value, which is to say its investment characteristics. The other is its industrial utility, its use as a germicide, and its use as a reflectant in solar applications. So while I understand the first part of the question, I think the attention that silver adherents pay to the 16-to-1 relationship between the relative abundance of gold and silver in the Earth's crust is probably less important than the social roles that they've both played in terms of investment demand or the industrial roles that they both enjoy.
Having said that, I guess historical means that you might think will be seen again? You've talked to us in the past about the overall investment percentage in gold, silver, and related equities, that sort of thing. Are there others that you expect? Maybe we could recap that one for everyone who didn't hear that before, but then any others that you think we might see again?
Sure. The discussion about reversion to mean on your show, Dunnigan, referred to the fact that the market share of all precious metals related investments, including physical precious metals equities, and public precious metals debt, comprises less than 0.5% of the value of all savings and investment assets in the United States. That's important, first of all, because the number is so small, but secondly, too, because the 4-decade mean market share of precious metals and precious metals related assets was 2%. So if you had reversion to mean, which I believe you will, that means that the demand for this asset class grows fourfold in the largest savings and investment market in the world. I think that's a broad enough asset class and a broad enough competitive universe that reversion to mean is an important statistical tool. To the extent that you want to use reversion to mean in something more volatile or more constrained, seems to me problematic.
All right. The next two questions are both about mergers and acquisitions. I'll do the longer one first, and then we'll hit the second one. Stephen Edmund VT8CF asks, "Hey Rick, down here in Australia, our government is trying to outstupid the US. This tends to be a theme around the world about working against all mining projects at every term. How do you factor this into development projects in your risk analysis?"
You tell him that we will always be dumber than they are, that they have no chance of catching us with regards to mining policy. Political risk is a given, unfortunately. In mining, your assets are fixed. If the questioner and I owned a freighter and one port became unfriendly, we'd sail out of the port and never go back there. Unfortunately, a mine in Western Australia is in Western Australia. Even worse, a mine in California is in California. You must assume the worst and hope for the best. What I try to do is benchmark jurisdictions in terms of their current larceny and greed, and in terms of what other sources of revenue are available to them more easily. But mercifully, in Australia, you have first of all, an economy that's unusually dependent on extractive industries. So there's only a certain level of stupidity that the government can afford. The mining industry is irrelevant in the United States, so the level of stupidity that we can afford here is much greater. Secondly, the sophistication of the Australian citizenry with regards to mining, whether they're employees or relatives of employees in Australia, is much higher. So that the electorate is more likely to spot stupidity in Australia than the U.S. electorate, who unfortunately would often be challenged to spell the word mine.
Another one, and this is the one I meant to read about Australian mergers and acquisitions, and this is from user-CX4, and it goes on. Where does Rick see the Australian mergers and acquisitions in gold going with activity heating up? We've recently seen mid-tiers Ramelius and Westgold fight for TSX Karora. Now just today, we see Ramelius advise of an 8.9% holding in Spartan Resources with a high-grade Never Never resource. So Australian M&As.
Going to heat up. M&A around the world is going to heat up. The reasons for that are fairly obvious. larger companies command larger market capitalizations, more trading volume, which means higher share price, lower cost of capital. In a capital-intensive business, a lower cost of capital is a decided competitive advantage. The second thing is, from an institutional investor's perspective, more scale means lower general and administrative expense relative to assets under management. And in the case of producing companies like Ramelius, G&A as a lower percentage of EBIT or free cash flow. Finally, having more assets in the company stable allows the management team to optimize the deployment of capital over a larger asset base rather than focusing their capital on one asset that might preserve their salary. The consequence of that is that mergers and acquisitions broadly, if they're well constructed, are a good thing. And we're early enough in the process that the benefits of mergers and acquisitions outweigh the costs. And I think you'll see them continue and probably increase, both in Australia and elsewhere.
This predates that question, and maybe you can help us give some backstory on why you said early in the process, because that's a bit of context to that. DJ706XK says, why the dearth of mergers and especially acquisitions in the gold mining industry?
I think part of that has to do with management incentive. Both sets of managers would prefer to be the survivor, but there can only be one survivor. And particularly management teams that aren't large shareholders, but draw good salaries and emoluments, are merger averse because it kicks them off the gravy train. I think that's the primary disincentive. What I think you're going to see happen in the next 2 or 3 years is that institutional investors will force mergers and acquisitions because the benefits in terms of higher share prices and hence lower cost of capital and lower G&A are so overwhelming that recalcitrant managers will likely be thanked and excused.
You've talked about energy as well as metals. You've talked about water. You've talked about a lot of things. ExxonMobil keeps coming up every time. So I'll go ahead and throw that out there again. You've talked about their low cost of good capital management, things like that, but go ahead.
Well, for most investors, ExxonMobil is the place that you start a natural resource investment portfolio. It's a large cap company that is extraordinarily well run and is cheap. They have historic high returns on capital employed. They've been historically very good capital allocators. In today's market, where the oil industry, as a whole, is underinvesting in sustaining capital investments to the tune of $1 billion a day, Exxon is stepping up the pace of sustaining capital investments and doubling up by spending $60 billion on Pioneer, which is to say, as big a producer as they are now, they'll be a bigger producer 3 years from now, when most of their competitors will be smaller producers. In addition to that, Exxon has made a series of discoveries in Guyana totaling about 11 billion barrels. The idea that they've had an exploration success that's big enough to move the dial at Exxon is incredible, but that's what they did. While developing an 11 billion barrel discovery, while spending $60 billion to buy Pioneer, and while increasing their level of sustaining capital investments, they have decided that this year they will increase returns to shareholders via buybacks and dividends by 14%. There are very few companies in the world, if any, that have both the ability and the will to do all of that simultaneously.
The petroleum industry is one example of one that does benefit from significant government subsidies of different types due to the long time cycle of their investment commitment and that sort of thing. DCW007 asks, how much of the natural resource sector is subsidized, and what sectors or areas within the supply chain are subsidized the most?
What are defined as subsidies to the oil and gas industry actually means that the government steals less from them by way of tax than they might otherwise do. That reduction in theft has to do with the fact that oil and gas assets are finite. If you and I owned a bakery, Dunnigan, bricks and mortar and steel and stuff like that. We could take flour and salt and water and sugar and butter in the front door and kick bread out the back door for 100 years. There wouldn't be any depletion. In the oil and gas business, if we drilled a well, after 10 years, we wouldn't have any income left. So in the case of both oil and gas and mining, the income is taxed differently. It's viewed as being a depleting asset. Very much, by the way consumer products companies are allowed to expense advertising, or pardon me, not expense advertising, but in fact write off advertising. The useful life of a customer that Heinz Kraft develops through their television advertising may be 15 years, but they're allowed to expense that customer acquisition via advertising in year one. So the oil and gas industry is subsidized the same way that the grocery industry or the movie industry or the television industry or the retail industry is subsidized, which is to say government agrees to steal less from them. That's the subsidy. Unlike the subsidies that, say, the electric vehicle manufacturer enjoys, where the government outright gives them $5 billion to build a plant and then subsidizes the consumer purchase of their output by $12,000 a vehicle, and then in addition to that, pays them to train workers. Those are subsidies. What the government does for Exxon is steal less. What the government does for Tesla or SpaceX is give them more. Those are very, very different discussions.
I think a lot of our viewers would like to be stolen less from. Think for yourself. 8258 says, what is Rick's view of deep sea mining?
I'd hate to pay the pumping costs. Deep sea mining probably becomes a thing 20 years from now in a limited scope and scale. There are wonderful, what are called nodules, precipitated collections of metal by submarine volcanogenic vents, where minerals in concentration come out of the Earth's crust and condense when they hit seawater, forming nodules that are frequently manganese, copper, nickel, cobalt rich. The difficulty with them, of course, is that you have to mine them robotically. And the technology to really do that, advanced robotic dredge technology, is early on. I suspect that deep sea mining will ultimately be a reasonable source of supply for things like cobalt, but I don't see it impacting world markets for 20 years.
You've mentioned this before, just seeing if there's been any migration in your thought process on this, and the question came up again. Big John 9596 asks, I'd love to know Rick's thoughts on gold or silver confiscation by the U.S. government.
I think, I wouldn't put any dastardly deed past the U.S. government, but I think the probability of it is low. People have asked me my whole life about the possibility of government confiscations of IRAs, too. The government can steal from you in ways that make them popular. Quantitative easing, which is to say printing more currency unbacked by anything, devalues the currency that you already have in your bank account. That's theft. When governments do it, they're popular. When government increases taxes on some, that's often very popular with the people that they didn't increase taxes on. It's a form of theft that gets them elected. When governments run big deficits like they are today, which is in effect stealing from the unborn or young people, that's popular with the people who are current beneficiaries of that. If you look at Social Security, Dunnigan, our generation, voted itself all kinds of cool benefits, Medicare, Medicaid, Social Security. Yes, we paid into them, but not to the extent that we're going to draw out of them. So the $100 trillion in unfunded, net present value of unfunded liabilities, the benefits that we will generate being paid for by younger people is theft. And 80% of the American population think that theft is more than justified. Given the fact that the government has all these ways to steal from us that are extremely popular, why would they engage in overt theft, which would be unpopular? I was reminded by a congressman, and I won't name him, that Congress is aware of the fact that there are 400 million guns in circulation in the United States. Think of yourself as a congressman. You run the risk, you run the ire of all the gold bugs, many of whom are armed, which is a risk, or you steal from the unborn, which makes you popular, gets you reelected time after time after time. Would you prefer to be loved for being a thief, or would you prefer to be shot for being a thief?
Well, that boils it down to that's the nut of the problem there. Okay, this is turning it to the individual scale. David 1977 says, what does Rick recommend on either how many troy ounces or percent of a portfolio one should have in gold and silver?
That really depends on the individual and the type of portfolio one has. As an example, a 65 to 70-year-old retired person with a lot of time left on Earth, whose portfolio is 75 or 80% in long-term bonds, needs to own a bunch of gold. Inflation murders a portfolio like that. They will get the bond yields, but the bond yields will buy less and less and less and less and less. An investor who has a reasonably leveraged real estate portfolio, reasonably, not unreasonably, who's a decent real estate operator, who benefits from inflation, because the ability of competitors in real estate to construct new product in inflationary times to compete with his existing product is low. So that person would need to own less gold. So while I know that everybody wants a one-size-fits-all answer, there isn't one. It depends on the needs of the individual, and it depends on the composition of their existing portfolio. I have much more physical gold in my portfolio than a financial planner would tell me that I needed. As an example, because I'm the largest shareholder of Sprott, one would expect that as the gold price increases, the assets under management at Sprott would increase and the management fees at Sprott would increase. And probably the popularity of Sprott in an increasing gold price environment would increase. So I would benefit from an increase in the gold price, whether or not I owned gold. But I own gold as an insurance asset. It helps me sleep nights and stay calm. And at 71 years old, 1 year of age, sleep is a very nice thing. I don't own gold because I think it might go from $2,400 to $2,700. I own gold because I'm afraid it'll go to $9,000 or $10,000. Somebody who has less fear than me probably wants to own a little less.
Again, at the personal level, well, I take it at the personal level because I think people who are watching this and concerned about what this question deals with are concerned about not only a systemic effect, but how it'll affect them personally. David Branham ZP1FO asks, out of the big banks to fail, which one do you think is in the worst shape due to the derivatives, which will be the first to fail?
The problem is that you can't look at the derivatives in a gross sense. You can't say that Citicorp has $50 trillion in derivatives and Bank of America only has $42 trillion in derivatives. You would have to know about every individual derivative contract. Is there a mismatch in duration? Derivatives are sold over the counter. And so as Warren Buffett points out, you have two rocket scientists, one at Citicorp and one at JP Morgan Chase. They sign a 15-year contract, and both of them assign a net present value profit to the transaction for bonus purposes. If there's a mismatch in duration, say 5 years on one side and 15 years on the other, they assign the net present value arbitrarily. So I am not capable myself at assigning a risking to the entire derivatives book at these big banks. Remember that the banks will tell you that the notional value of the derivative, the notional pricing of the derivative is very different than the real price because the derivatives exposure has been hedged. That's true as long as both parties pay. But if one party doesn't pay, then that portfolio becomes decidedly unhedged. I think a different problem that bank investors and bank depositors and borrowers need to face is the duration risk. You have a lot of banks where if they were required to mark their asset base to market, particularly their long-term bonds, their mortgage bonds of greater than 7-year duration, that mark to market would wipe out the bank's entire capital. The banks are allowed to hold those assets on the books as being held to maturity and ignore the market price of those assets. In other words, they are encouraged by the government to perpetrate securities fraud. And if you ask your bank for a statement of financial condition, which they are obliged to give you, you can look in portfolio composition at that percentage of their assets which are closed, quote, held to maturity, and determine without too much effort what concentration risk your bank employs. I can tell you, Dunnigan, at Battle Bank, our duration risk will be nil, which is to say that we will not fund long-dated fixed rate assets, loans, with overnight deposits. That's what brought down the U.S. savings and loan industry. It's what brought down Sovereign Bank. It's what brought down Silicon Valley Bank. The temptation that these guys have to chase 11 or 12 basis points in yield by going out 8 years on the duration curve and funding that with overnight deposits is an insanity.
Before we get, there are several questions on Battle Bank, and I was going to follow up. You brought it up first, but I'm going to ask one more question about mining. First, Misk Invasive 1793 asks, could you please ask Rick to comment on Ivanhoe Mines, in particular their Platreef and Kipushi mines?
First of all, disclosure of conflict of interest. I have a very large shareholding in Ivanhoe Mines, a material shareholding. I'm delighted to say that my average cost is substantially below $1. And I've taken enough out of the trade that I have no net exposure to the company. Now on to the question. Kipushi will be at nameplate capacity in terms of production in about 9 months. It is the highest grade zinc mine in the world by a substantial margin. There is, of course, political risk because it, like Kamoa-Kakula, is in Congo. Congo's a frontier market, make no mistake. Unlike Kamoa-Kakula, at Kamoa-Kakula, Ivanhoe's partner is effectively parastatals controlled by the government of China, so that China is their protector. At Kipushi, Ivanhoe has no such advantages. I would expect things to go well at Kipushi, and I would expect Kipushi to generate really substantial, really surprising free cash flow for Ivanhoe, particularly given the completion of the new rail facility from Katanga, the so-called Lobito Corridor rail corridor, which means that Ivanhoe can now ship both copper and zinc concentrates by rail as opposed to by truck. I think that'll make a huge difference. The Platreef is a much different discussion. The Platreef is the largest undeveloped concentration of high-grade precious metals on the planet, particularly platinum and palladium. Platinum and palladium have decreased in price by 50% in the last 18 months. Because of that, I like platinum and palladium, and I like the byproduct, nickel. This will be a major capital expenditure. It's important to note that 10% of the deposit is owned by JOCMEC, the government of Japan. So one might expect that the Japanese government would exert some form of diplomatic pressure on the government of South Africa not to steal. We'll see how successful that is. A major capital expenditure in South Africa without the new mining code is challenging. This is an unbelievable deposit. If Ivanhoe can find a way to craft an intelligent fiscal stability agreement with the South Africans and hold the South Africans' feet to the fire with regards to what they're able or intend to steal, this will be a stupendously profitable asset, one with a current mine life well in excess of 40 years. But there are obviously political risks. The recent election in South Africa had no successful conclusion. The African National Congress, which is to say the incumbents, attempted to fashion a coalition with the Democratic Alliance, which is a much better alternative for South Africa. It looks as though they have been unsuccessful in dividing the spoils in terms of cabinet with the DA. And now they are looking at fashioning an alliance with MK, an overtly communist party, and the economic freedom fighters who advocate the nationalization of every economic interest in South Africa, and sing a song called Kill the Boer, which advocates the murder of white South African farmers. So when somebody is considering a $1 billion plus investment in South Africa, you need to take into account the current and past political and social reality of the country.
All right, one more specific question, and then we'll get into some general questions. Phil4277 says, what is your opinion of the potential Donlin mine in Alaska?
Donlin will not be built in the immediate future. It's a huge, huge, huge deposit, but remote. There is a high-grade core, which they need to expand with more drilling. The permitting regime in Alaska for these large, remote deposits was unfortunately set back by the Pebble process, which took 13 years and resulted in the Department of Interior nixing that proposal. At any rate, my own suspicion is that the upfront capital costs associated with building Donlin would generate at current gold and copper prices an internal rate of return that would be insufficient to finance it, given the upfront capital requirements. On top of that, of course, you have political and environmental opposition.
Now, you brought up the words battle bank earlier, and I promised we'd circle back to them because there are multiple questions on that. These are very pithy questions. The first one is from Jamie Cush. When can we park our silver in Battle Bank?
When the FDIC gives us permission to open. We are ready. The FDIC, in their defense, has had a challenging couple of years with bank failures, and those challenges continue. Every time there's a bank failure, my application gets deeper in the stack as opposed to coming up the stack. We have had very good feedback in the last 15 days from the FDIC, but we've had good feedback from them before. So the honest answer to the question is, I don't know.
And now I wanted to give you a chance to remind our viewers what you have in store for them in the upcoming Rule Symposium on Natural Resource Investing in Boca Raton, Florida, your flagship conference, once a year only, and this time fully available either in person or virtual. So could you lay that out for us? Because frankly, there were so many high quality questions. They just go on and on and on about specific companies, specific projects, etc. I've not seen this level of demonstrated specific questions on the topic of mining companies and mining. It's really encouraging to me. So what can the people learn by attending either in person or virtually?
A lot of things. First of all, the conference has stood the test of time. There is a group of attendees at this conference who have been coming for 25 years or more. That means historically that we've done a good thing. Historically, too, Dunnigan, we've tried to make the conference a little better every year. And if you do that for 28 years, you make it pretty good. How do we make it pretty good? Well, first of all, we present really, really, really good global macro, and not the kind of global macro that you see on CNBC or CBC. You see Jim Rickards talking about the structure of the financial community. This from the guy who was chief counsel for long-term capital management, where he just about destroyed the financial system. Nobody knows the whale like somebody in the belly of a beast, and he has been there. You have Nomi Prinz talking about the structure of Wall Street. She's a former Goldman Sachs partner and a financial services analyst. Again, from the belly of the beast. Daniela DiMartino Booth talking about the Fed, head of research at the Dallas Fed. Belly of the beast. After we have taken people through global macro as it is, not the way the big thinkers wish it were, we give you specific strategies from analysts and portfolio managers who have stood the test of time in natural resources, 3 decades of experience, not 3 months of experience, the way you would see in some newsletter writers who flunked out in crypto, flunked out in pot stocks, maybe flunked out in natural resources once before, but real battle-tested, successful veterans. Then my favorite part, we have a group called the Living Legends, entrepreneurs who have built multi-billion-dollar oil and gas or mining companies from scratch, telling you what it took to do that, what lessons they learned, why those lessons made them better investors, and how you can be a better investor too. To quantify it, how do you spot the $5 million company that's on its way to being a $5 billion company? That's why you listen to the Living Legends. Every single public company exhibitor at our conference has been personally vetted. If they aren't owned in our accounts, they can't appear on our floor. There is no guarantee that because I own a stock, it goes up, as you well know, Dunnigan. But there is a guarantee that the process is honest. Our attendees have told us that our exhibitors are content too. And so for that reason, we have vetted them. Additionally, there is a core of high-quality attendees. The idea that all the knowledge in the room comes from the dais out to the crowd is ridiculous. You will learn a lot from your fellow attendees. Listen to the questions that they ask. Talk to them while you're getting coffee, or better yet, talk to them while I serve you free alcohol in the boat cruise. Finally, I suspect the fact that whether you attend live or via live stream, you will have access to all of the conference proceedings recorded for the balance of 2024 is important. We're going to give you 60 hours of high-intensity, high-value programming over 4 days, and you are not going to be able to absorb it all. You are going to have to refresh your memory at best, and you will have the ability to do that. All of those factors, plus the ability to be not just Dunnigan Kaiser, but the Kaiser family live, says that you have to come. And if for any reason, if you attend either live or via live stream, and you aren't satisfied for any reason, there's a gold-plated 100% no questions asked money-back guarantee. In other words, I'm confident enough after 28 years of doing this, with the quality of my speakers, the quality of my exhibitors, the quality of your fellow attendees, the quality of the resort, which is just incredible. If for any reason, live or live stream, you don't think that I've given you your money's worth, no questions asked, you get your money back.
And in the past, you've also extended offers to rank our portfolios of natural resource stocks if we send you that information, and also give us more information about Battle Bank, which you continue to do here, but in more specific terms. How can people take advantage of those?
Go to ruralinvestmentmedia.com. List your natural resource stocks. Please no crypto. Please no pot stocks. Please no tech stocks. Natural resource stocks only. And if I know them, I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comment has any value at all. Now, as to banking, if you're thrilled with your current banking relationship, there's no need to reach out to me. I have learned that the community of people who are thrilled with their existing relationship is extremely small. So if you would like a bank that has one simple deposit product that pays you high interest, including on your checking, you might want to check us out. There are big box banks that have 16 deposit products, 6 of which pay you no interest. What use is that to you? If you think that you might want to take out a certificate of deposit in some currency other than the U.S., we will offer CDs in 18 currencies. If you do business, as an example, both in the U.S. and Canada, you might want to open a Canadian dollar CD with us and transfer money between the 2 accounts to save FX fees. Or you may just decide that there is another currency, say a resource-rich currency like the Australian dollar, that you'd like to park part of your savings in. We can do that for you. If you think that your IRA should belong to you, you might check us out. At most institutions, your IRA is a receptacle for their mutual funds or annuity. At Battle Bank, your checkbook IRA can own a duplex or a triplex, which you operate. It can invest in private credit. It can buy a franchise. This is all legal. At Battle Bank, your IRA is your IRA. If you believe that your IRA should belong to you, you should check out Battle Bank. If you are a Dunnigan Kaiser, Miles Franklin client, and you believe that you should own bullion, at Battle Bank, if you would like to, you can borrow against that bullion. It's odd that other banks don't consider bullion to be good collateral. Delightful for me that they don't consider it to be good collateral, but odd. And one thing that you get to enjoy being a depositor at Battle Bank is that you know that your money isn't invested in some goofy derivative or in a 30-year bond to Greece, but rather it's invested in effect in a margin loan secured by physical gold and silver. That product, I think, should give both borrowers and depositors real, true cold comfort. So if all of that appeals to you, you can either go to battlebank.com or just as easily go to Rule Investment Media. And under the question and comments tab, after you've listed your natural resource stocks for ranking, simply write in bank, and we'll put you on the wait list. I'm delighted to say, Dunnigan, that the number of people on the wait list waiting to do business with Battle Bank, either as depositors or borrowers or IRA holders, now exceeds 14,000 people. In our prior bank, EverBank, which we grew over 14 years to $28 billion in deposits with roughly the same business plan, when we opened, our customer backlog was zero. I repeat again, our customer backlog now is 14,000 people. Many of them, of course, people who felt abandoned after EverBank was taken over by TIAA-CREF.
I wanted to congratulate you on that backlog of advanced business, and also to thank our viewers and subscribers for being here on Liberty and Finance, because we have our presence on multiple platforms, YouTube being the core one, but we also are on Brighteon, Rumble, SoundCloud, and many others. But just on YouTube alone, we were just sent by YouTube this plaque of 100,000 passing 100,000 subscribers just on YouTube alone, and in recognition of that. And we're grateful for all the subscribers. The interesting thing is, and think about this, people watching this video, about half of the people who view our videos are not yet subscribers. All you have to do is just click the little bell, the notification. Make sure you click subscribe and then click the bell. You'll be notified every time we issue a new video, and you won't miss a single episode with Rick if you get on our free mailing list at libertyandfinance.com. So just go to libertyandfinance.com, put in your email address, click submit, make sure you confirm on the confirming email to opt in, and you'll get one email in your inbox each day with our latest guests, including all of Rick's videos and any weekly specials, and help our channel to grow by subscribing and forwarding it to others as well, so we can spread the knowledge. Rick provides us so much education for free here. It's a shame if we don't spread it to others, so please help out in that process. And Rick, on behalf of all of our viewers and subscribers, who many of whom are looking forward to meeting you and myself at Boca next month, thank you for joining us again here on Liberty and Finance.
Well, thank you, Dunnigan, and my profound congratulations for the 100,000 subscriber bogey. Richly deserved, but I'm delighted that you're beginning to reap the rewards of a decade's worth of effort.
Yeah, and it's really helped reach critical mass by my sons joining me on the team, because we're publishing now six major episodes every night, Monday through Saturday at 9 p.m. Eastern, 6 p.m. Pacific. And when it comes to partner interviews with individual mining companies, often we have to fit those in as matinees at noon Eastern, 9 a.m. Pacific. So several days now we're publishing twice per day and at least 6 times a week. So that's really doubled plus almost tripled our volume of content and it made it very regular and predictable for subscribers. They love that. So thank you as being a big part of that. And they love partaking in being able to submit questions ahead of time because it makes us all learning together. And I just get the privilege of being here as a representative of all of our audience. So thank you for letting me do that and for being with us.
Thank you. Great lesson there. You work hard, you deliver value, and after 10 years, you become an overnight success. It's wonderful.
Thanks again for being here, Rick.
Thank you.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for June 24th through July 1st, 2024, while supplies last. First, we feature Ital Preziosi Silver Kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.